Have you ever wondered how Forex trading works? Well, let's dive right in. Forex trading, or foreign exchange trading, involves converting currencies with the aim of making a profit. And we're not talking small change here. Each day there's a staggering $6.6 trillion being traded on this global platform. So how does it work? Well, currencies are traded in pairs, and these pairs are traded in lots. The prices of these lots are quoted in something called pips. Now, when you buy a currency pair, you're essentially betting that the base currency will strengthen. Conversely, if you're selling a currency pair, you're anticipating that the base currency will weaken. In essence, Forex trading is all about predicting the strength and weakness of different currencies. It's a game of strategy, analysis, and a keen understanding of global economics. And we're just getting started. Now you might be wondering, how do you actually go about trading currencies? Well, it's all about the spread, margin, leverage, and your trading style. First, let's talk about the spread. In the simplest terms, the spread is the difference between the buy and sell prices of a currency pair. This is how brokers make their money. When you enter a trade, you're essentially paying the spread. Next up, we have margin and leverage. These two concepts allow traders to open positions with just a fraction of the total value of the trade. Think of it as a type of loan from your broker. It allows you to potentially make larger profits, but remember, it also amplifies your potential losses. So, use with caution. Finally, let's discuss trading styles. Depending on your risk tolerance, time commitment, and overall strategy, you might choose to engage in scalping, day trading, swing trading, or position trading. Scalpers make numerous trades throughout the day, aiming for small profits. Day traders, on the other hand, open and close all positions within a single trading day. Swing traders hold positions for several days to weeks, capitalizing on price patterns and market trends. Position traders, the long-distance runners of the trading world, hold positions for months to years, banking on long-term trends. Understanding these mechanics is crucial to becoming a successful Forex trader. So, what factors influence the Forex market? Well, let's dive right in. One of the major factors is central bank policies. You see, central banks regulate money supply, control interest rates, and manage inflation. All these can cause currency values to fluctuate. The economic outlook of a nation also plays a vital role. When a country's economy is thriving, its currency typically strengthens, and when it's not, well, the opposite happens. Economic indicators like GDP, unemployment rates, and consumer spending all come into play here. Then we have geopolitical events, wars, elections, trade disputes, you name it. These events can create uncertainty, and markets, as you might know, don't particularly like uncertainty. But remember, the Forex market doesn't sleep. It operates 24 hours a day, 5 days a week. Yes, even on weekends, trading is available on select pairs. In order to excel in Forex trading, it's important to keep an eye on these factors and understand how they influence currency values.